A company called Southern Trust told the United States Virgin Islands government it provided cutting-edge consulting in biomedical and financial informatics. It received $73.6 million in tax exemptions. It performed no consulting. It employed 13 people. 6 were secretaries, receptionists, and a driver. Its sole shareholder was Jeffrey Epstein. And according to federal prosecutors, its actual function was to act as a conduit for payments to foreign women, credit cards, airplanes, and the operational infrastructure of a sex trafficking network. This episode follows the money through the machine Epstein built to make it disappear. Before we trace how $800 million moved through 2 shell companies in the U.S. Virgin Islands, there is an attorney at the center of this machine you need to know about. He built the trusts, he opened the bank accounts, he signed the documents. When Epstein died, he received $50 million in the will. He has never been criminally charged. His name is Darren Indyke, and his role in this story comes later. First, the machine itself. Because what Epstein built in the Virgin Islands wasn't a company, it was a financial operating system. To understand the machine Epstein built, you have to understand the place he built it. The United States Virgin Islands is a U.S. territory in the Caribbean. Its residents are American citizens. Its courts operate under U.S. law, but its tax code operates under a completely different set of rules. The USVI Economic Development Commission, later renamed the Economic Development Authority, offers qualifying businesses a package of incentives that includes a 90% exemption from income taxes, 100% exemption from gross receipts and excise taxes, 100% exemption from withholding taxes, and 100% exemption on real property taxes used for qualifying business activities. The intent of the program is to attract legitimate businesses to the territory. The effect, in Epstein's case, was to create a government-subsidized tax shelter for a criminal enterprise. In 1996, Epstein relocated his primary business to St. Thomas in the U.S., Virgin Islands, and renamed it the Financial Trust Company. The company offered what it described as private wealth management, brokerage, and investment advisory services. It received EDC tax benefits. By 2012, Financial Trust had reported assets of approximately $212 million. Then, in 2012, Epstein created a second company, Southern Trust Company, also incorporated in the USVI. Southern Trust applied for EDC benefits in October 2012, claiming it would provide cutting-edge consulting services in the area of biomedical and financial informatics. The governor of the Virgin Islands signed off on the certificate. Southern Trust received a 10-year incentive package running from February 2013 through January 2023, 90% income tax exemption, 100% on everything else. Between 2013 and 2017, Southern Trust reported approximately $184 million in revenue. But here is what federal prosecutors found when they examined the company's actual operations. Southern Trust performed no informatics or data mining services during this period. None. It employed 13 people. 6 worked as personal assistants, executive assistants, receptionists, or as a driver. 1 was a clerk. 1 was an office manager. 3 worked in accounting or payroll, though only 1 was a licensed CPA. The company's revenue did not come from consulting. It came from a single source, the fees Epstein collected from his 2 primary clients. Leslie Wexner, approximately $200 million. Leon Black, approximately $170 million. And the funds that flowed through Southern Trust did not pay for informatics services. They were funneled, at the direction of Epstein's lawyers, to Epstein's personal accounts and other Epstein entities to fund what prosecutors called the Epstein Enterprise. The Virgin Islands government stated it directly. These funds appear to have not been used to pay for informatics or data mining. No other entity in Epstein's enterprise generated revenues. Funds received from the single source were funneled to Epstein's personal accounts and other Epstein entities to fund his criminal activities. A consulting company that didn't consult. Revenue from 2 billionaires, funneled to fund trafficking. Tax exempt at 90%. That is the Virgin Islands playbook. And it was just one layer of the machine. Southern Trust and Financial Trust were the primary revenue engines, but the machine had many more moving parts. According to USVI prosecutors, Epstein, working with his lawyers, held and managed at least 140 different bank accounts, for Epstein personally and for Epstein-owned entities. Many of these accounts existed for one purpose only, to transfer payments to other entities and accounts. That number is worth pausing on. 140 bank accounts. Not for a corporation with thousands of employees, not for a multinational conglomerate. For one man and a network of shell companies, most of which had no employees, no offices, and no operations. Let me name some of them so you understand the scale. JEGELLC, Cyprus Inc., Financial Ballistics, LLC, FSFLLC, FT Real Estate Inc. Great Street, Jim LLC, Hyperion Air LLC, IGO Company LLC, Jeepers Inc., Laurel Incorporated, Little Street, Jim LLC, LSJE LLC, LSJ Emergency LLC, Maple, Incorporated Michelle's Transportation Company, Nautilus Inc., Plan DLLC, Poplar Inc., Prytany LLC, Southern Country International, Thomas World, Air LLC, Zorro Management LLC, Mort Inc., CDE Inc., Freedom Air Petroleum LLC, the COUQ Foundation, the Epstein Foundation, Inc., the Butterfly Trust, the 1953 Trust. And every one of them had accounts at J.P. Morgan. The architecture is deliberate. Each entity adds a layer between Epstein and the transaction. When Southern Trust pays Hyperion Air, it looks like a corporate intercompany transfer, not a convicted sex offender funding a private jet. When Nautilus Inc. pays for construction on Little St. James, it looks like a real estate company developing property, not an island where trafficking took place. When the COUQ Foundation makes a payment, it looks like philanthropic activity, not operational funding. This is what money laundering looks like at the private wealth level, not suitcases of cash, not wire transfers to numbered Swiss accounts, shell companies paying other shell companies through real banks with real account numbers, generating real compliance paperwork that no one reads carefully enough, and the money that moved through these accounts was structured to avoid detection. Federal forensic accountants, part of the U.S. Attorney's Office in Miami, traced transfers from financial trust company to shell entities in the U.S., Virgin Islands, Cyprus, and Switzerland. Many of these transactions fell just below the reporting thresholds. This technique is called structuring, deliberately keeping individual transfers under the dollar amount that triggers an automatic suspicious activity report. Investigators described the network as intentionally designed for concealment. By spring of 2007, investigators had identified at least 6 businesses controlled by Epstein that were processing transactions unrelated to their stated activities. The investigation was building toward a federal money laundering indictment, a draft. Indictment was prepared. An 82-page prosecution memorandum was written. The indictment detailed mechanisms linking J.P. Morgan Chase, Deutsche Bank, and First Republic Bank to trust entities registered in the USVI, Luxembourg, and Switzerland. That indictment was never filed. The investigation was shut down. And Epstein received the non-prosecution agreement that allowed him to plead guilty to a state charge in Florida and serve 13 months in a county jail with work release. The offshore machine survived, the bank accounts remained open, and the money continued to flow. The draft indictment linked J.P. Morgan, Deutsche Bank, and First Republic to Epstein's offshore entities. It would have exposed the full architecture in 2007. It was sealed. It was never filed. And for the next 12 years, the machine ran. But someone had to build it. Someone had to incorporate the shell companies, open the bank accounts, and sign the documents that made the entire structure function. That person wasn't Jeffrey Epstein. It was his lawyer. His name is Darren Indyke. For more than 2 decades, Indyke served as Jeffrey Epstein's exclusive attorney. He was a graduate of Cornell Law School. He operated out of a 10th floor office at 301 East 66th Street in Manhattan, a building Epstein owned. The same building where Epstein housed foreign and underage models, including one who arrived at age 15 and was later named as an unindicted co-conspirator. Indyke's office was the legal engine of the Epstein machine. He incorporated the shell companies. He signed the formation documents. He held signatory authority on numerous bank accounts for Epstein-linked entities in both the United States and the Virgin Islands. He served as an officer or director for multiple Epstein-controlled companies, including Nautilus Inc., which owned Little St. James, and Southern Trust Company, the entity that defrauded the USVI for $73 million in tax incentives. He purchased the Manhattan townhouse that Ghislaine's Maxwell lived in, a property at 116 East 65th Street, through an anonymous LLC for $4.95 million. The seller was Lynn Forrester de Rothschild. He served as a trustee of Maxwell's Max Foundation from 2001 to 2010. He co-managed, with Epstein and accountant Richard Kahn, at least 140 different bank accounts. Many existed, as prosecutors stated, only to transfer payments to other entities and accounts. After Epstein's 2008 conviction, prosecutors alleged that the operation shifted focus to procuring and abusing women from Eastern Europe, whose immigration status and language barriers made them more isolated, dependent, and vulnerable. Indyke allegedly provided the legal mechanisms to facilitate this shift. He provided a letter of reference for at least one immigration application. He arranged tax services for the women's spouses. Kahn and Indyke directed payments to the immigration lawyer who applied for citizenship for the women, and threatened at least one who indicated she would seek a divorce. And then Epstein died. On August 8, 2019, 2 days before his death, Epstein updated his will. The 32-page document named Indyke and Kahn as co-executors and co-trustees of the 1953 trust. It directed that after payment of debts, all remaining assets would flow into the trust. Indyke received a $50 million bequest. As co-executor of an estate once valued at $600 million, Indyke controlled not just Epstein's financial legacy, but access to documents that could implicate some of the most powerful figures in the world. The estate reached a settlement with the U.S. Virgin Islands, over $105 million in cash, repayment of over $80 million in fraudulently obtained tax benefits, transfer of half the proceeds from the sale of Little St. James, surrender of Great St. James Island, termination of all Epstein-related business operations in the Virgin Islands, no admission of wrongdoing by the estate, by Indyke, or by Kahn. After the settlement, Indyke briefly worked for a lawyer representing Donald Trump in his classified documents case. He then resumed his solo practice in Delray Beach, Florida. Darren Indyke has never been criminally charged. The Virgin Islands' shell companies were the domestic infrastructure, but Epstein's financial architecture extended far beyond U.S. territory. The International Consortium of Investigative Journalists, the same organization that published the Panama Papers, revealed Epstein's offshore footprint through the Paradise Papers investigation. Epstein chaired entities like Liquid Funding Limited, incorporated in Bermuda. His offshore companies were, in the ICIJ's words, loaded up with complex securities and opaque ownership, creating layers that separated Epstein's name from beneficial ownership on public records. These weren't exotic financial instruments. They were standard tools of the offshore wealth industry, the same tools used by corporations and individuals worldwide to minimize tax obligations and maximize financial privacy. What made Epstein's use of them extraordinary was not the tools themselves, it was what they concealed. The offshore entities connected to banks across multiple jurisdictions. JP Morgan, as we documented in episode 4, but also Goldman Sachs, HSBC, including Swiss private bank accounts, and Deutsche Bank. Each institution processed inflows and outflows across Epstein's entity network, enabling the movement of money between jurisdictions in a way that made tracing beneficial ownership nearly impossible. The USVI prosecutors described the full structure: the Virgin Islands companies, the offshore entities, the trusts, the shell companies, and the bank accounts as the Epstein enterprise. Not a loose affiliation, an enterprise, a coordinated system designed to generate revenue, minimize taxes, conceal ownership, fund operations, and shield participants from liability. And here is the number that puts the entire enterprise in perspective. Between 1999 and 2018, Epstein's two main USVI companies alone received over $800 million. His offshore entities held additional assets that have never been fully disclosed. The total value of assets controlled by Epstein and his network across all jurisdictions has never been established. The estate was estimated at $600 million at death, but prosecutors, investigators, and the Senate Finance Committee all believe the true figure is significantly higher. We don't know the total. And the reason we don't know is that the machine was designed to make it unknowable. This episode is called The Offshore Machine Behind the Money. But the machine isn't unique to Epstein. The USVI tax incentive program that Epstein exploited is still active. Shell company formation in secrecy jurisdictions is still legal. Structuring transactions below reporting thresholds is a known technique that compliance systems struggle to detect. Beneficial ownership registries remain incomplete in most jurisdictions, and the gap between filing a suspicious activity report and taking enforcement action, the same gap we documented in episode 4, remains unchanged. Epstein's machine was sophisticated, but it wasn't exotic. Every component of it, the USVI tax shelter, the Bermuda entities, the shell companies, the nominee directors, the Swiss accounts, the layered bank transactions, is available to any ultra-high net worth individual willing to pay the legal fees. The difference is what Epstein put through the machine, not tax-efficient investment returns, not legitimate estate planning, a sex trafficking operation that prosecutors described as an enterprise, funded by revenue from 2 billionaires, processed by 4 of the world's largest banks, and sheltered by a tax incentive program designed to attract consulting firms. And the architect of the machine, the lawyer who built it, who signed the documents, who opened the accounts, who held signatory authority, who arranged immigration papers for trafficking victims, and who received $50 million in a will updated 2 days before his client's death, has never been criminally charged. If you take one thing from this episode, the offshore financial system does not distinguish between legal wealth management and criminal enterprise. It processes both through the same structures, the same banks, the same jurisdictions, and the same incentive programs. And the cost of building the machine is a legal fee. The cost of operating it was over $800 million in revenue to Epstein's companies. The cost of it being discovered was settlements, paid by the estate, not by the architect. The architecture is still standing, the tools are still available, and the next machine is already running somewhere. Here is what we now know. Jeffrey Epstein built a financial machine across the U.S. Virgin Islands, Bermuda, Cyprus, Switzerland, and Luxembourg. At its center, two companies, Financial Trust and Southern Trust, that received over $800 million in revenue between 1999 and 2018. Southern Trust claimed to be a consulting firm. It performed no consulting. Its revenue came from two billionaires, Leslie Wexner and Leon Black. Its money was funneled to fund what prosecutors called the Epstein enterprise. The machine included at least 140 bank accounts, dozens of shell companies, offshore entities in secrecy jurisdictions, and a tax incentive program that saved Epstein $300 million on companies that funded trafficking. The machine was built by Darren Indyke, Epstein's exclusive attorney for 20 years. He incorporated the shells. He held signatory authority. He arranged immigration papers. He received $50 million in the will. He has never been charged. The banks processed it. We covered that in episode 4. JP Morgan, Deutsche Bank, Goldman Sachs, HSBC, each won a node in the network. The billionaires funded it. We covered Wexner in episode 2 and Black in episode 3. This episode connects the infrastructure, the machine that made the money untraceable, the architecture that turned advisory fees into trafficking operations, and the tax incentive program that subsidized it. And there is one final piece of this investigation remaining. Throughout this series, we've asked how the system allowed this to happen. Episode 6 asks the harder question: who was supposed to stop it, and why didn't they? The prosecutors who wrote the indictment and watched it get sealed. The regulators who fined the banks but filed no criminal charges. The politicians who received the evidence and held no one accountable. And the non-prosecution agreement, the single most consequential legal decision in this case, that shut down the money laundering investigation and let the machine run for 12 more years. Episode 6, The Epstein Files, The Men Who Let It Happen. That's the final episode. It drops soon.